Here's what I do to invest in self-storage right now to find the opportunities that will create wealth and have upside. I started in very small facilities in very rural towns, and I scaled to hundreds of millions of self-storage assets. The simple methodology that you use really hasn't changed, and even what I'm doing today follows this. If I was starting over again, this is exactly what I would look for and how I would go about it today. Today is very different than self-storage has been in the past. The last 3 or 4 years in storage have been a struggle, with occupancies and rents dropping. But in 2025, we saw stabilization, meaning rents stopped dropping, occupancy stopped, and over the last 4 or 5 months, we've actually seen them start to rise. But the key is most people won't see the opportunity or know what to do until the market is booming again. And that's when there's no opportunity. So how do you find opportunity? What do you do today to find it and get it? The things that I'm focusing on today, even if we're talking a small facility, maybe $200,000 to buy and invest in, we've got to take into account both opportunity and risk. The first thing that I'm looking at is value add or distressed properties. Right now, I'm buying a lot of distressed properties, but we also are focusing on value add. Now, what does that mean? First of all, distressed properties are almost always wrapped into owners that have to sell. This may be a lease-up facility, a new development, or simply someone that bought and now their refinance is coming up because they bought in 2019, 2020, 2021, or 2022, and they got to move their loan into a perm loan. They have to refinance. Interest rates are higher, occupancy and rents are down, and they've got to get rid of it. The opportunity of value add. Really, we're looking at the exact same thing that I've always done. That is mom and pop operators that treat it as a passive real estate asset. This affords lots of opportunity without a lot of risk, meaning that it's known. We can see everything that's going on. They're just not operating it in a way that they should, therefore leaving that money on the table. The first thing that I do has 2 parts. That is our buy box. And our buy box is compiled up of size, type of asset. It's what kind of self-storage facility I want to buy. Do I want climate controlled? Do I want small drive up in a small town? The next thing I do is geographic area. Now, when I got started, it was really simple. There weren't any fancy tools that we could find assets, that we could do any kind of market study, nothing like that. I simply looked at where I lived, did a map around a freeway that went through about 4 states and said all the small towns in there I wanted to look at, all small assets I wanted to take a look at. I couldn't afford to buy big assets worth a lot of money. So instead, I looked at assets, we're talking under $1 million. In these markets, I made some simple rules. So first thing, my buy box, mom and pop drive up facilities that were in good locations. I mean, micro locations, like where were they in the city? But they had opportunity in operations. The owner was more passive, wasn't really doing anything. They weren't marketing. There was no kind of rate management at all. It was just, here's what it is. I want it to be occupied. The next thing I looked at was the market. What I would do is I would look at the markets and I would look at 2 things in that market. The first thing would be that micro location. The second thing would be, is that market growing or dying? Now, I don't need markets to be booming. I'm really looking for markets that just aren't going to be half the size in 10 years than they are now. After that, we have a list of different markets and we know what kind of facilities that we want to buy. Let's say that's $500,000, small drive up in a bunch of these markets in this geographic location. The geographic location, you want to be big enough to where you have options, lots of facilities that you can buy, but also you don't want to be getting into markets that are so foreign that you don't understand them and you don't feel comfortable with them. From there, I make my list. Then I look at the market of storage. That's the next part of this. You see, the number one threat to self-storage, as I always say, is self-storage. Oversupplied markets. Now, when you're dealing with distressed assets, lots of times they are in markets that may be oversupplied. But you can overcome that because your basis is so low that you're buying them in. But that's the key. That has to match up. And if I was just starting out, I would probably avoid that unless I could see simple things. Occupancies were stabled, rents were coming up, and occupancy had returned and come up. Meaning I know the baseline, I know that supply is what it is, and the rates and the occupancies aren't falling, they're going the other direction. The next thing I want to look at is the future supply. In those markets, is anyone building? Are they going to build? Because that would dramatically change the inventory on the market and the supply. And then if they are, I don't know. Will that cause occupancy and rents to drop a lot further or not? I'm not sure. So I want to avoid that in all situations. So when I'm looking at the market of storage, I want to see a market where inventory is known, we don't have new supply coming in, and it's stable. So I have a market that's not dying, the market of storage that isn't oversupplied, and then I have assets that are either distressed or mom and pop value add. Put those three things together, we have a winning combination.
Have you been wanting to get into self-storage but struggling on the next steps to take? So you may not know, but I wrote a book that's hard to even call this a book. I mean, this is a manual. We're talking 400 plus pages, which include all sorts of information about how we have been in the self-storage industry. That's everything from how we got our first deals, to scaling, to buying deals in today's market, what's changed and what remains the same. This is an up-to-date book that shows you how the market has changed and how you can win today. This isn't simple, this is how you buy a deal. No, this goes into everything, including how you scale and create a self-storage business. You can get a physical copy, an ebook, or the audiobook, plus free access to bonus content at the end of each chapter. You can get it today. It's available on Amazon and other platforms in which you can follow the link.
Now, this is an important caveat. A lot of people may look at the market, they go online or see a broker listing, and they say these prices are too expensive, so they don't even look at them and move on. We do not get opportunity. We make it. Meaning, of course, the sellers are going to try to get the highest prices they can, and that's what they're going to list them at. But prices of assets that are selling are not trading in the vast majority of markets in the United States for what they're listed at. It's far below. So if you pass it up because the price is too high and you don't want to pay it, you're going to find that it's sold to somebody else at a much lower price that you would have loved to have it. So don't ignore it because of price. If it meets those three things, now we want to look at putting an offer. We want to make the deal. Things to avoid: new supply that is still trying to fill up and struggling. Why? They'll drop rates even further to try to fill up the facility. New supply that will be coming onto the market that will fundamentally change the demand. Markets that are shrinking and shrinking rapidly, where our overall demand of people will be less in 5 years than it is today. A market that has really low occupancy, sub 70%, that could be a signal of trouble. And when we're looking at markets that have lots of vacancy, the thing that will fix it is people moving in. So if you're growing, or you have a market that's growing, but it's not growing by a lot, and you have really low occupancy, what's going to change that? Unless they tear down facilities, it's going to be a real struggle to get those facilities to all fill up if you don't have a market that has lots of people moving into it. So you need to avoid that. Now, luckily for 90% of everyone investing in storage, they're going into markets, basically 80% of all markets in the United States, that did not have either booming population or even have lots and lots of new facilities that opened up because the economics didn't make sense. There's markets all over that are mom and pop driven that didn't have new supply, or the new supply that came on was little and it's stabilized after 4 years. How I would identify the value add. I'm looking at facilities that do not price differently. Now, I have a strategy for that where it's very simple and you have 3 different categories. I did a podcast on that, and there's also a YouTube video, so please go check that out. And it shows you a simple way that you can literally do on a piece of paper with a pencil to understand pricing and see the opportunity in a value add asset there, or even change your asset to optimize price by identifying our 3 different groups of units. So check that out. That'll help you a lot to understand that value add portion. Also, let everybody know in the comments what you guys are doing. Make sure you guys like and subscribe because that helps me. That is the currency of podcasts and YouTube. So please do that. That helps me keep giving you guys all this education and free content. As far as things that make a market good, those things that we mentioned, bad in reverse. Also, housing supply. So how many units are coming online? Is there housing growth? People moving helps storage. Once again, if you have low supply in a market, so you have high occupancy, that's really not as important as if you have a market that has low occupancy because of excess supply. Who's going to fill it up? Look at housing starts. This is really important when you're looking at distressed assets that are distressed because of low occupancy and rates. The next thing, I would get together my team. This is not something you do alone. You need to have a team of professionals, not that you hire, but that you work with. We're talking about real estate attorneys, people that do this, not your friend, not a neighbor or your local attorney, real estate attorney, CPAs. You want to get feasibility studies, market analysis done by third parties. All this helps you compile it to make a good offer, submit an LOI, as well as put information out to the bank that'll help you get a loan. Now, as far as buying the facility, I would go 2 different routes. You could either use a bridge loan if there was enough cash flow that you would get rid of fairly quickly if you don't have enough money to put down, or an SBA loan, which allows you to do a small business loan with putting much less down than a traditional commercial real estate loan. Normally, a bank is going to want to see 30 to 40% down. SBA loans can be as low as 10%. It's a big difference. The next side would be investors, family, friends, or going out to people that have money and are looking for opportunities. The key with this is get the opportunity first. Then you have something to show, and you can show the numbers. From there, I would start negotiating with the seller. Lots of times, you can get rid of the bank and do seller financing. This actually happens a lot, especially today. We see off-market deals done and sellers that are willing to seller finance. Now, why would they want to do that? Well, it's simple. If I have a 7% interest rate on a loan that I have to buy to get a property, I'm not going to be able to pay as much if it's a 3% loan. So lots of times I use my 3-offer strategy. What we can do is put an offer. Here's the price that I'll pay, let's say $1 million with a traditional bank financing. Now, maybe you can take on a portion of that and we have a bank on the other portion. We do kind of a hybrid thing. You're not going to be able to have first place. The bank will want to be first in line on the debt, but still we do a hybrid. Maybe that's the down payment portion that I'm going to make payments to you on. Now, if we want to do that, well, I'll pay you more. Now I may pay you $1.1 million. Now, the third option is you finance, I'll put 10% down, and I can use a bridge loan, or maybe I can have investors come in and help me do that. And then I'll pay you 1.2 or 1.3. Why? Because the loan amount is so much lower that now I have a lot more cash flow and availability to pay it. Now, I'm not saying overpay at all. That's not what I'm talking about. It needs to be in relationship to the price and what things are trading at. And that's the big win right now. Cap rates have risen. So in order to sell properties, people are having to sell them at a lower price. That's an incredible opportunity for you. This is more pronounced in smaller markets with smaller operators. They have to sell it at a much lower amount. Why? Because banks, investors, and everybody else is going to underwrite that at a new price point than it was when interest rates were nothing, literally free. Just can't pay. So they really don't have an option. From there, I would get a good due diligence period. And I'd want a closing date that allowed me to have enough time to really dive in. Now, here's a professional tip. In the contracts we put in, due diligence doesn't actually start until I receive all the information from you. So let's say that I have a 30-day or 60-day due diligence period, but I don't even get the information from the seller for 2-3 weeks into it. Well, all of a sudden, half or 80% of the time for due diligence is gone, and I haven't been able to do it. So we issue all the things that we need from the seller. Now, if it takes you 2-3 weeks to get me that, the due diligence timeframe starts from there. The 30-60 days starts from there. That then gives me enough time to take the information, give it to third parties, get a feasibility study done, get it to my CPA, get it to the attorneys, start working with banks. I would look at the individual asset to solely understand the money on the table. Now, what is that? It's the same thing that I wrote about in both of the best-selling books on storage in detail. That money on the table is that opportunity regardless of the market going up. Now, this could be a lot of things. We see a lot of times large delinquencies. We see total rate imbalance, meaning that you may have a site that says we're selling 10 by 10s for $100, but then you look at it and what they're actually charging their current tenants is $50. That's the difference between actual occupancy and economic occupancy. Be careful with this. As part of our community, literally last night, we went over and all the brokers did was took the rates that they were charging, those street rates, and apply that to the units and came up with value. But when you dig into the numbers, you say those aren't the actual rates that are being charged. They're far below that. So the reality is your net income is way less than those applied rates. This difference between physical and economic occupancy tells you a lot. Then you apply our 3 different category of units to understand which units have demand and which don't. That tells you where you can get rates to today, what they should be, and what risk you have of losing occupancy. Another tip, almost all vacancy is concentrated in basically 3 different product types. Remember, units are products, customers are tenants. You may have 10 different types of units, but 20% vacancy. The majority of the vacancy will almost always be concentrated in just 3 units because those units were overbuilt. So identifying those units and how much those units make of the total population of units give you a really good idea of I can't not only increase those rates, I may even have to lower them. But the other units, I may be able to increase a lot, taking those $50 to $100 where they should be at because there's demand. The owner just never gave rate increases. This is common. A lot of mom and pop owners focus on occupancy, not revenue. Remember, storage is a business, not a real estate asset. We care about revenue and net income, not occupancy. So I would look at that and I'd figure out on the revenue where pricing, occupancy is not aligned, where that owner has never gotten rates up to market rates, where they haven't given in-place rates, and I can see the difference. Then I'm going to look at expenses. Where are they spending too much? How are they not operating it well? The main indicator for me is marketing. Are you actually marketing online? Do you have a dynamic site where people can rent online? Can I use technology to automate it? Which the answer is almost always yes. This allows me to perform higher in the market. You have to remember when we look at demand, we just assume that everything's equal, but that's not how it is for customers. The demand for the customer is very different. Let me explain. You have 10 facilities in the marketplace. We look at all the units and all the people, and we say that's how much supply and demand is in the market. But to a customer, they may only know about 3 of those facilities. In fact, they may go to buy a facility online, which 85% of our customers come from your phone or researching it. They ask Siri or they Google it. And you may have 5 facilities that aren't doing anything online. To that customer, those 5 facilities don't even exist. So demand is not spread equally because demand has to be what the customer actually can see and know. So your ability to compete online increases your demand. If you have a owner that is not doing that, they don't have normal hours of operations, no one's picking up the phone, they're not marketing, you can increase the demand simply by letting people know you're there and answering the phone. That gives you the ability to raise your street rates, but also raise your in-place rates, and when somebody moves out, simply fill it up. The important part of money on the table is just what they're not doing that they should be doing in today's marketplace, and what the difference of that is to your net income. If you have 10% delinquencies, you make everybody pay, you immediately increase gross revenue by 10%. If you have a bunch of people that are paying far below market rates or what other people are paying, all you do is make them just pay what is being charged today. That dramatically increases your overall revenue. If you do not have a marketing or a sales system in place, they are not capturing the demand in people in the marketplace today that want a unit. So you can change the overall demand for that location. These things dramatically improve revenue of the business and your net income. And those are things that you can change and change quick and easily and not have to rely on the market to just go up. What we have to make sure with the market is that we're not fighting against it because you will lose every time. This is included in what I call my margin of stupidity, meaning I have to be able to be stupid and for it to still be okay. If I'm trying to fight the market, it doesn't matter how smart I am, you're going to lose. The next thing that I would look at is the actual returns and what my goals and objectives are. I like to get my money and profits out quickly. Now, that doesn't even necessarily mean selling the facility, but in a 5-year period of time, I may want to refinance my money and profits out and then redeploy it. This is what I did for over 20 years. That allowed us to scale to over 150 million in assets without even taking on an investor. Because we improved the assets, we refinanced it, we went out and bought another one while we kept that asset. We did this over and over and over again. We didn't lose the revenue, we didn't lose the asset. And 2, we're not even taking on just more debt. We're not loading up the properties with debt. We keep the same debt to equity level. So let's say we put 30% down. Well, all of a sudden, after you've improved that property, your debt to equity is no longer 70-30. Now it's 50-50 because the revenue has increased so much in relationship to where you bought it. So now all I'm doing is refinancing to the same 70-30 level that I bought it at, and I'm taking that equity and profits out tax-free, redeploying it and buying another one. Today is the perfect time to do that system. Why? Because we are at a bottom. Cap rates have gone up, occupancy and rents have slowed. What you also don't see is that we have cratered new supply. High interest rates have shut down supply. So in most markets, there's no new inventory coming back on. And it takes a long time to get to new inventory. So by the time occupancy and rates recover and start going up in a big way, then new supply comes on. Well, it's 3 years till that new supply comes on. This creates massive pent-up demand, higher occupancy, and rates that just keep going up. This is exactly what we saw after 2008. That's what I would do today. If I was starting from nothing, I would immediately go back, small facilities, mom and pop, in good markets that aren't oversupplied. I'd buy them, I'd increase their net income, revenue, refinance, and do it again. Let me know today what strategies you are doing to get that money off the table, to finding new good deals, and please like and subscribe. Help me out, everybody. Thanks.